So we've done a bunch of videos already talking about the importance of the PE ratio and its ability to identify whether or not a company is significantly underpriced. In the most recent one where we talked about it, we talked about Korong and KCC Glass, which since then have both departed from the bottom of the PE ratio standings. Now, however, more companies have reported yearly earnings and it's time to revisit the potentially distressed, potentially on sale stocks at the bottom of that chart. You're watching Sekkider, and this is the PE ratio and its shortcomings. Now, before we continue, we'd like to remind you that this channel is meant for general education purposes only and isn't meant to replace the financial or legal advice of a paid professional. We're simply a YouTube channel trying to help you wrap your head around some of these concepts. We can't know if a stock is right for you, but we can help you learn how to figure out whether or not it is. So, it would be highly appreciated if you could do us a solid, scroll down, hit the like and subscribe buttons, and we'll keep the content coming to you every single week. Now let's get to it. Alright, so once again we're looking at investing.com's rankings of the price to earnings statistic. And you can do so by yourself by following along with this video, but the process is very simple. Just go to investing.com, click on stocks, find the KOSPI, and click on the fundamentals tab. Once that's done, all you have to do is sort by PE ratio ascending and scroll to the first tangible earnings ratio. If a company doesn't have an earnings ratio, it means that either the firm is losing money or they're simply not making money at the moment. We're not really the type of channel that looks at companies that don't have any earnings at the moment, so we're definitely going to be looking at something other than that today. Alright, so when we looked at Korong and KCC Glass, they were sitting at a PE ratio of roughly 3, and holy hell, we've got a firm that's less than 2 in Taeyong Construction and Engineering. That's basically an auto buy, right? Of course not, because the PE ratio could be low for a bad reason, like, I don't know, the market just isn't interested in it right now, but it could also be down for a good reason, like maybe the earnings aren't legit, or there's some question to whether or not they can last. Let me show you what I do before diving into financial statements, just to know whether or not I'm even interested in a company in the first place. So the first and easiest thing that anyone can do is Google. Google is your friend. We quickly search up Taeyong ENC and choose a couple of the most recent and relevant articles relating to the firm that pop up. Now the first one is from Business Korea, which is actually a really helpful resource if you just want to know what's going on in the market at the moment, but yeah, we're going to use this, and basically it mentions that the company's subsidiary TY Holdings has been diversifying into big projects like wastewater treatment. Now the second one is from the Korean Herald, and it's just a record of must assets divestment from the company in the third quarter of last year. The second article also includes important coverage of Taeyong's efforts to focus on the core development businesses by spinning off management into their minor projects like SBS, golf courses, and waste treatment facilities, among other things, into a new holdings company called TY Holdings. Their subsidiary was mentioned in that Business Korea article as well. Alright, now that I have a basic understanding of what the recent developments of the company are, albeit limited in scope, it is a good time to start looking at the actual financials. Now, again, I like to do a once over on Reuters because they have these dope little graphs on the right that show you year by year trends that tell me whether or not the past years have treated them nice. One of the main things I noticed from the jump is that their operating income and their revenues have either been stagnant or dropping over the past 3 years. And when moving over to cash flows, we can also see that their net income was absurdly high last year in comparison to previous years. Now, we already know that last year was only moderately difficult for the construction industry, who oversaw some upticks in orders received for 7 of the 12 months of 2020 as the government actively attempted to draw construction and engineering companies back home. However, orders do not immediately translate into profit, and any improvements from last year would not have been able to improve the cash flows this much this quickly for a single firm. Also, if we switch into a quarterly view of the company's cash flows, we see that much of their net income came to them in the third and fourth quarters of 2020, so that gives us a bit of a hint of where to look. Now, to get a better understanding of what happened, it's really important to check the financial reports of the firms themselves. Alright, so I know for a lot of people it's actually hard to find this information since it's not readily available on every site the way that it is for foreign firms, right? A lot of it is going to be in Korean, so basically what you have to do is just click around a bit, search for company name, investor relations, sometimes at work, sometimes you end up with something like a PDF from 2013. For the sake of saving my time and yours, I already did the search, and the way that I got to their IR data was to go through their holding group's homepage, click on the ENC tab under subsidiaries, and then root through there to find their documents page. As you can see, they have quarterly and annual reports going all the way back to 2004, if you so desire to look that deep. Alright, now for the sake of this video, we are not going to look that deep. So starting with this yearly report, we see basically the same thing that we saw in their cash flows on Reuters. Unusually large income growth in spite of significant losses in sales and operations. Now their 2020 sales patterns mirror those of the industry at large, whereby civil engineering orders grew while everything else kind of fell through. But the net change once again does not account for the inflow of profits this large. Luckily, this is explained on page 7 of their report, in which it states that the valuation of associates and subsidiaries' assets contributed to the increasing in net profit before tax. From the articles that we read, and the note at the bottom of most of these IR pages, we can understand this to refer to their corporate spin-off of TY Holdings, which, just through another quick Google search, we can see debuted on the KOSPI in September of last year. Now this is important because if we scroll through their key statement of financial position, we see that the majority of their asset growth came in the shape of cash or cash equivalents, or in other words, from the sale and their equity stakes in TY Holdings. They also include growth in their inventories and tangible assets as well. And just like that, we have built a very simple but also much more informed opinion on the company and why its PE ratio is almost on the floor. Now obviously it's very difficult to know exactly why markets behave the way that they behave, but from a personal perspective it seems to me that much of the earnings part of the PE ratio is best understood as being the result of a one-time influx of money born of the corporate spin-off that put TY Holdings on the market. This is to say that this is just a really unnatural event that may have brought in a lot of money last year, but it's going to be very difficult to repeat. And if anything, it just makes their PE ratio at current less important overall. Now, of course, to really understand how their ENC business is going right now, it would benefit you to check their full financial audit material, which is, unfortunately for us, written all in Korean, but simply based on what we know about the company, it's not really something that I'm personally interested in putting time and effort into, but that isn't to say that it's not worth it. I just have limited time to spend on my research, and based on the entry research I've done, I'm pretty confident that there are significantly more interesting and lucrative deals out on the market currently. In the end, the main point of this video is to provide somewhat of a case against the use of PE ratios as an individually important statistic in your evaluations. It's easy to look at something low, like at 1.5 times earnings, and just assume that a company is extremely undervalued, but like most tangible statistics, the PE ratio is backwards looking and doesn't tell you anything about how the number was reached in the first place. We know that Taeyong's spin-off of TY Holdings was done so that they could focus on their core operations. Whether or not this focus will translate into further growth in the future has yet to be seen, and it would be great if it did, but developing a fair hypothesis on this would take further research or better understanding of their operations, which we're not going to do, but if you want to figure that out, you're going to have to do that for yourself. Alright, that's it for us today. Hope you found this helpful, and if so, please share this around with anyone who may also want to see a more specific example of how one might go about conducting basic stock research in the Republic of Korea. Till next time. Be easy, fam.